California defaulted on their debt. They issued IOUs at the same rate at whatever debt was maturing, which happened to be 3 3/4 then. And it wasn't that long that you had IOUs and then got the payment in arrears with interest.
Right.
That could happen.
All right. Well, for more on all of this, let's bring in Bill Foster, sovereign analyst at Moody's Investor Service. Great to have you with us. Thanks for joining us to answer these burning questions. Is Karen's trade, does that sound right in terms of the scenarios that she's laid out?
Well, we certainly expect the U.S. government to continue to honor its debt. We don't expect an interest payment to be missed. That's our base case. There's a lot of noise, obviously, around the debt limit Brinkmanship issue. We've seen the same thing in prior episodes, but ultimately we think the deal will get done and the X date won't be crossed and the Treasury will continue to pay its debt on time and in full.
I want to make clear to our audience that you are an analyst at Moody's. You wouldn't be part of the downgrading of U.S. debt. But is it possible that the U.S. doesn't even have to default to have a downgrade happen to it? And so then what happens to the curve?
Well, I am the sovereign analyst that covers the U.S. government. So
you would downgrade the debt?
Yes. Well, I'm responsible for the sovereign credit rating. But ultimately, the short answer is our definition of a default is missed interest payment. Any other payments that might be missed with regards to Social Security, prioritization of other payments, that's not a default by our standards. So it would have to be a missed interest payment would need to occur for a downgrade to happen.
Oh, okay. Because I was under this for some other ratings agencies, as I understand it, it could just be, sort of like a terrible functioning of the U.S. government could trigger a downgrade.
Well, yeah, I mean, I guess the question, Bill, is on August 5th of 2011, S&P downgraded the U.S. from a AAA to a AA+.
Which it still is at.
And that was seemingly a day the music died, even though it really wasn't. And Karen brought this up on one of our shows recently. You actually had a massive rally in the Treasury market after that for different reasons. Some of them were because of what was going on in European sovereign markets. But can you just talk about, again, the perception of the U.S. And the credit worthiness as it goes into an overall rating and maybe what S&P was thinking, but what you might be thinking, despite the fact that they're going to pay and until they default?
Well, from our perspective, the U.S. has a very strong credit profile, and the things that stand out for the U.S. versus other AAA rated economy, AAA obviously is the highest rating that we have, for 12 sovereigns with that rating. The fact that the U.S. has the global reserve currency of choice, dominance, just below 60% of global reserves are in the U.S. dollar. And then you have the deepest, most liquid bond market in the world, the Treasury bond market. That removes the risk of any foreign exchange risk for the U.S. government or any funding risk generally. It's also the largest economy in the world, obviously, and extremely resilient to shocks. And we've seen that time and time again. That really helps buffer the credit profile for the U.S. Even in a situation where we might have a missed interest payment, those types of things really help keep it close to AAA. If we had a missed interest payment, the scenario would be first, if it was resolved within 15 days, we would keep that rating very close to AAA, probably at AA1, provided there was a resolution before the next interest payment in 15 days and the debt limit issue was resolved.